Good evening, traders and investors. Will back here with another one, coming to you with a Monday market recap. Hopefully you guys had a very good day in the markets today, and hopefully you had a very beautiful weekend as well. And in today's action, the S&P up 0.2% and the Qs up about 0.5%. However, once again, market breadth remains a concern. Technology and some semiconductor names were up a lot today. However, that is kind of where it stops. Once again, the heat map looks like this, to where over the course of the day, big tech not doing too bad. We have a few key performers here in semis, especially your infrastructure semiconductors. But that's kind of where the bullishness stops. You will notice we are once again missing a whole big portion of the S&P 500 as our breadth continues to weaken and weaken and weaken. Matter of fact, if you take a look at the 1 week relative performance, you will see that other than some big tech names that perform very well after earnings, the whole rest of the market is nowhere to be seen. And not only is it nowhere to be seen, declining in a very big fashion. Now, if you haven't seen Saturday's video, I put out a massive video explaining exactly what's going on under the hood in terms of the lack of overall sector rotation, the lack of overall market breadth, and why that's a problem. I spent the first half hour in that video going over a ton of statistics and what could possibly be the implications of those statistics. And then we obviously derived some narratives that are currently at play in the market, which are right here on the screen. Some short-term bearish narratives, some longer-term bullish tailwinds, and of course we derived some possible conclusions as to what we could best do to position ourselves, depending on the size of our accounts, our risk tolerance, and all that good stuff. So if you haven't seen that massive video on Saturday, I would definitely recommend to look at the first 30 minutes of the video, because I'll be referencing that video all throughout the week, or for the entirety that this market breadth weakness simply continues at this current stage. It's tough for me to recap that every single video because it takes a long time, so definitely check it out if you didn't have the time to do so. In other news, well, we didn't really have anything in terms of macro news today. Nothing big for that matter. We had ISM manufacturing that came out this morning. It showed that manufacturing PMI was at 48.7, still very soft, but that's been a problem for the markets over the course of the past 2 years. As you can see right here, we're just not able to get out of the manufacturing rut in terms of economic output. One of the good things about that report, though, is it did show that ISM manufacturing prices paid was a little bit lower, which could be decent for inflation and shows that perhaps the impact of tariffs is still somewhat muted, but it could maybe accelerate into the end of the year, of course. That's pretty much it for your macro news today. So today was largely just a day of normal price action. Tech and AI doing relatively well, and the rest of the market just nowhere to be seen, unfortunately. But there was one big piece of news that happened that I was pretty happy about, and it's this one right here. Guys, we finally hit 10,000 subscribers on the channel, so thank you to each and every one of you that's taken the time to watch the videos, like, comment, and subscribe. This is a big milestone for me, and I'm pretty happy. I know it's not a lot of subscribers, but still, we've been building this channel for over 2 years at this point, and I was really looking forward to this, so thank you guys so much for helping me hit that goal today. Very happy with everything indeed. So in today's video, guys, we have a few things to look over. Since there's not too much in the words of macro news, we'll kind of just get right into some earnings and some charts. So we're going to start it off with two big company earnings that had earnings today, which are people's fan favorites, Palantir and HIMS and HERS. Now, of course, there's many other companies that reported today, but we will focus on these two because they have the most amount of retail interest and they did move pretty decently in the after hours. So we'll be looking at Palantir's insane numbers, and we're also going to be looking at HIMS and HERS. They had a very good, decent earnings report as well. You'll see that it's a very busy week this week, especially for retail fan favorite stocks. You got Uber, Shopify, Spotify tomorrow, AMD, Arista Networks, Supermicro as well. Wednesday, got a couple ones too. McDonald's, Robinhood, AppLovin, Qualcomm, ARM, Elf Beauty. And then on Thursday, of course, we have more companies, Trade Desk, Open Door, MP Materials for that critical minerals play, Iris Energy that just got a very big deal today from Microsoft, DraftKings, Airbnb, so many fan favorite names. So it should be a very fun week in terms of earnings, as opposed to a very serious one like last week, where we had most of the major tech corporations reporting. Those big corporations move the indexes a lot more. But this week, we'll be able to get a good sense of sentiment and how Wall Street is going to react to a lot of these fan favorite retail growth stocks overall. So today we'll do Palantir, HIMS, and HERS to start off the video. Thereafter, we will get in directly to our technical analysis and spend some time talking once again about the rotation. or lack thereof between the different sectors of the market. Thereafter, we will do the same thing on our big tech list down here and derive out of these big tech names, some of which have ran tremendously over the past quarter, which ones are still buys for swing trades and which ones are possibly still buys as well for long-term portfolios in terms of their forward valuations. Towards the end of the video, if we have time, we probably will have time, we'll do the biggest gainers and losers of the day. To the downside, you had a lot of companies, not only some fast-growing tech names that just didn't get some love today, but I mean, a whole segment of the market, right? So many of these companies have been bleeding out and bleeding out and bleeding out. Are any of them still some good opportunities, or should we just be cautious and stick away? So we will do the biggest gainers and losers of the day at the end of the video. And at the very end of the video, I'll be taking you guys through my portfolio for some of the trades that I put on today and which trades I'm keeping into the rest of the week as well, in terms of how am I positioned leading into this market breadth weakness, 6-7 months of rally on the SPY and Qs in a row, extensions from the 12 EMAs, and all the concerns that we kind of raised in Saturday's big video. And that's going to be it for today. So it should be a very fun video, probably a lot shorter than Saturday. So let's jump right into it, shall we? So on to the SPY, up 0.2 and the Qs up 0.5%. As I said, just taking a quick glance at the heat map again in terms of our one-day relative, guys. It was just a question of big tech, and not all of big tech. Amazon surging higher today after striking a deal with another data center provider, CIFR, which, by the way, had earnings today. This company right here, Cipher Mining. I don't even know if it's there. Oh, there you go, Cipher Mining. And that actually that was actually advantageous to Amazon overall. So they had some pretty good news on the day, but Tesla coming up as well. NVIDIA, very strong day for them too. And thereafter, Amazon as well, they had a big deal with OpenAI, $35 billion to be specific. So that's also a reason that they were higher today. We were missing Apple, missing Microsoft, and Meta continues its earnings declines. Google, not too bad. And then we had a whole bunch of companies that did a whole lot of absolutely nothing. Financial still down, healthcare still down, the bottom half of the market still down, and your market breadth continues to unwind. And now you're starting to see it on the sector relative performance, guys. Cyclicals, which was largely Amazon and Tesla today, didn't fare too bad. Technology, not too bad either, because you did have overall decent tech performance. Utilities coming up a little bit, and that's kind of where it stopped. Every other segment of the market, red. And now you'll see it best on the 1 week relative, guys. We're losing sector by sector, and it's not soft. These are fairly big declines. Consumer cyclical and technology, the only ones higher. And once again, those are a byproduct of the earnings that we just had. Other than that, the rest of the market is missing. And now we're starting to lose some of the gains across the board on our 1 month relative performance. A few weeks ago, this chart was mostly all green. And now you're slipping and slipping and slipping, losing more sectors as the days move on. Fear and greed index still remains in a bit of a fearful environment because of that low market breadth. You got a lot of concentration right now. Market momentum is good because the markets are still being carried and close to the all-time highs just by a few key names. But look at this, net new 52-week highs and lows on the New York Stock Exchange. Clear weakening here since the month of September. Now, arguably at some of the lowest levels in terms of net new highs versus lows, as we've seen pretty much all year, at least since after the whole tariff debacle. Stock price breadth, again, very, very soft, guys. We're coming back into levels that we haven't seen since February, essentially, the start of the whole tariff sell-off too. And put and call option ratios, well, not too many people are buying protection, which is a little bit curious. But still, right? These markets are relatively soft and it has people a little bit on edge. Now, before we get into more technicals, guys, let us do a little bit of a dive into 2 corporate earnings that we have today. And number one, the one that everybody wants to see, is going to be good old Palantir. Now, Palantir, you might see the stock down 4.27% in the after hours. That, of course, is because the stock has ran from these lows end of October to where it was right now, 23%. So is a lot of the move baked in? Possibly, but it's not because they had bad earnings. As a matter of fact, guys, this company just posted the best earnings in terms of net growth rates in the entire S&P 500. They are the fastest growing technology company in the S&P. They are by far the fastest growing software company in the S&P as well. And their peers are quite strong as well, right? You got a lot of fast growing cybersecurity companies in the S&P. Palantir is better than every single one of them. Their earnings this quarter were absolutely outstanding. I cannot take that away from them. So although they are down in the after hours right now, it's not because their earnings were bad. This is some of the best earnings that the market has seen all year, and some of the best earnings that you possibly may ever see from a fast-growing tech company. In terms of their EPS beats, guys, 25% beat on EPS. That's not very easy to do. And an 8% beat on revenue on guidance that had already been increased last quarter. So they beat the raised guidance, which is absolutely nuts. If you take a look at some of the easy numbers for Palantir here, revenue was up 63% year over year. That's an acceleration, guys. Last quarter, they were at 49%. Now it's accelerated 63% quarter over quarter. Massive. US commercial revenue was up 121%. That is absolutely massive as well. I'm telling you guys, these numbers were insane. Q2 numbers for commercial revenue was 47%. 47% is outstanding. 121% is just in a league of their own. Rule of 40, they're at 114% right now, guys. They are pretty much on par with NVIDIA. We'll look at that a little bit later, right? But Palantir, look, in relation to competition, right? They are way ahead of absolutely everybody versus software companies. And a lot of these companies are very solid and fast-growing companies too. In terms of the top 25 companies of market cap globally, Palantir stands at number 2 in terms of rule of 40, which is basically a byproduct of the revenue growth rate plus your adjusted operating margin rates, only second to NVIDIA. Palantir is growing revenue faster than NVIDIA, but NVIDIA just has better operating margins, but still kind of standing all on their own here with NVIDIA, which is absolutely phenomenal for this business. Moving on further, operating income was up 118% year over year. They continue scaling revenue on all segments extremely rapidly, but the company is getting more and more profitable. If you take a look at some more segments of their earnings, guys, every single one of these numbers was a ridiculous beat. In terms of their forward guidance, they beat that, guys. Forward revenue guidance are now about 4.4 billion. The estimate 4.17. That would be an increase of 53% year over year. This is for the entire fiscal year. So they're raising Q4 again. End of year US commercial revenue, 104% is the guidance right now. Adjusted operating income, they beat that as well. Very strong, 2.15 essentially versus 1.93. So being even more profitable than previously anticipated. Adjusted free cash flow, that got a raise as well to about $2 billion at the midpoint versus the 1.92 expected. And your Q4 numbers, I mean, that's fiscal year. But if you take a look at the Q4 guidance, guys, revenue guidance here, that's going to be up 61% year over year, beating the estimates, their own previous guidance as well, and adjusted operating income as well by almost $100 million, guys. These are not easy numbers to put up for any company, let alone Palantir, which already has some pretty stiff comparables of their own, right? Take a look at the segment breakdowns right here. Total revenue in the US, which is their most important market. Alex Karp highlighted this on the earnings call. He was saying, you know, our numbers would have been even better overall, but it's just Europe has been severely lagging behind. But their US performance was staggering. 77% year over year revenue in the US, 20% quarter over quarter. Phenomenal. US commercial revenues, we talked about it, up 121%. 29% quarter over quarter, and US government revenue up 52% year over year, 14% quarter over quarter. These numbers are all absolutely insane. When you look into the margins of the company as well, the amount of free cash flow that they're able to raise, everything is excessively strong, right? And despite all of that, the stock still went down because there's not really a lot of room on this company, right? It's ran tremendously already. It's already in the past couple weeks up 22% from the base of the support before this leg of expansion. So the stock might just be getting a little bit tired, meaning it might be tough to find some buyers up here. But you cannot say that these numbers are bad by any metric. They beat on everything, raised on everything. And once, as I said, guys, this is the company with the best earnings in the entire S&P 500, and arguably, it's not even close. Let's take a look at the letter to shareholders, because Alex Karp definitely did not refrain from stating the obvious in today's earnings call, which was a video webcast presentation. I highly recommend you guys, if you're Palantir shareholders or interested in the company, that you watch the earnings call today with Alex Karp. It was a masterclass, essentially. So here's what he had to say. we are still at the very start of things. This remains the beginning, the first moment of a first chapter. Very strong introduction from Alex Karp. This ascent has confounded most financial analysts and the chattering class whose frames of reference did not quite anticipate a company of this size and scale growing at such a ferocious and unrelenting rate. Good old Alex Karp using all of the adjectives possible in the book, right? Some of our detractors have been left in a kind of deranged and self-destructive befuddlement. Essentially what he's saying is, people said we've been overvalued and overvalued and overvalued and overvalued, and yet our stock price keeps rising and we keep defying expectations. So he's kind of calling out people who haven't made any money on the stock, namely the analyst community that's been reluctant to position now for the past year since the stock kind of blew through 40, 50, 60 bucks. It has indeed been difficult for outsiders to appraise our business, either its significance in shaping our current geopolitics or its value in the vulgar financial sense. The reality is that Palantir has made it possible for retail investors to achieve rates of return previously limited to the most successful venture capitalists in Palo Alto, and we have done so through authentic and substantive growth. Now, this is very true, guys, right? Palantir has made a lot of people an absolute ton of money, but you had to have had conviction. I myself built my position. I mean, I started my position in 2021. Then even I had to take a 40, 50, 60, 70% drawdown down to $6, dollar cost averaging, and I did not see the fruits of all of those buys for years. It took, guys, years. Now, granted, I've been clipping out on the way up. It would have been very fun to hold all of my shares still here. I still do have a decent amount of shares, however, but Palantir has made myself and a lot of you guys watching this video probably a lot of money, and Alex Karp recognizes that, and this letter is kind of an ode, a thank you to the people that have had conviction in the business model and in the technology, which, I'll be honest with you guys, is revolutionary indeed. The segment of operations is an absolute juggernaut, talking about the U.S. commercial business, and we believe that it will become, on its own, one of the most significant business stories of the century in American economic life. During the earnings call, Alex Karp was highlighting and contrasting Palantir and its efficiency gains when its model is implemented into a commercial business versus so many other software companies, which, let's just say, he didn't have very kind words for. Referencing, there's a whole other batch of companies out there with software propositions that basically just tries to sell you a piece of software and then just basically say, well, yeah, we'll deal with it. It's supposed to improve your productivity, but who knows? As opposed to Palantir's core approach of working with businesses directly, finding where they're lacking and working with the business hand in hand to improve the business efficiency, improve the business's productivity overall, and doing so while not increasing its labor force. Palantir, Alex Karp was talking a lot about the earnings call, about saying that they're able to scale to these numbers without having to have massive sales teams. As a matter of fact, their sales headcount actually went down, which is defying the traditional business model of a software company with a massive sales team just trying to drive a product down your throat that you may not even need or may not truly get the most bang for your buck from. That being said, that was a lot of the stuff that Alex Karp had to say, but I reference this again. If you guys have the time, go watch the earnings call with Alex Karp and his management team. It was a very high quality thing. Now, we referenced the rule of 40 already, but what we'll do is move down. We already ran over most of the numbers and how staggering they actually were. We're going to look at some of the things that Palantir has accomplished over the course of the quarter two. Now, you might remember about last week, right? We had Alex Karp and Palantir teaming up with NVIDIA, putting the ontology software in line with NVIDIA's CUDA software as well for even more efficiency and productivity gains, which is probably going to be one of the best combinations in the entire market, in the entire world, arguably. These two companies working together for automations and obviously analytics and workflow purposes as well. Moving on further, they are leading the future of automotive manufacturing. 11,000 employees leverage Palantir across 175 use cases, driving efficiency and contributing to $30 million in savings for these businesses in the first half of 2025. And if we take Alex Karp's words to the bank, they are just getting started. A first chapter. This is their partnership with Lear, who obviously makes aircraft, right? Now, they're also doing battlefield innovation at full speed. We know Palantir has a ton of US government contracts, but also many contracts across the European Union too. Very solid there. And here are just a few of the use cases, right? So here is one in terms of a healthcare use, right? Hospital for special surgery used Palantir to automate insurance appeals processes. 45 minutes of manual work went down to 5 minutes, and they did that work within 5 weeks, which is insane. Usually it takes companies 6 months, a year plus usually to implement software packages that the engineering team may not know too well how to integrate into the business. Palantir's main competitive advantage, guys, I've said it, I'll say it again, is the boot camps. They work with you hand in hand, and they make sure that your engineering team knows exactly how to implement their product across the business, and they focus on what really needs to be changed, not just some fluff, right? Moving on a little bit further here, in terms of American Airlines. American Airlines deployed Palantir to reimagine their network planning ecosystem. It's been just about a year's journey with tens of millions of dollars already saved. We can't wait for what's next. And you guys know the airline industry is not the highest margin business, so they need to get money back wherever they can find it. It's been doing really good for them. And now lastly, here we have BP, British Petroleum, right? An oil company. For us, I can say to you again, very confidently, year on year, we're getting triple-figure returns from the investments we've made in Palantir. All of these good comments and all of Palantir's implementations so far have led to an increase in customer count. The amount of customers that they've been gaining is quite insane, right? In terms of the deals that they're closing, 204 deals of about $1 million this quarter, 91 deals of at least $5 million, and 53 deals of at least $10 million. Not only are they acquiring new customers, but the customers they already have are working with them even more, which gives this business a retention ratio of 134%, meaning that not only is every single client staying with them, but the clients that are staying with them are spending even more money, which gives them total remaining performance obligations of about $2.6 billion at the current stage. That's about a year's worth of revenue for Palantir overall. So extremely, extremely strong earnings. They're working with nuclear companies. They're working with all types of companies overall. We've already really went over the financials. We're not going to go over them more, but just some fancy little charts right here, improving net income. Net income, guys, for this business right now, you're talking about a business that prior was struggling to achieve profitability in 2020 through 2022, 2023 that flipped, and so far this year they've increased margins from the very beginning of the year, Q1, from 24% to now having net margins of 40.25%, almost 2xing their net margins, which is absolutely ridiculous for this company. Operating income, adjusting operating income is very strong too. US revenue growth, there it is, right? US commercial government revenue growth, very strong, no problems there. Once again, overall commercial and government growth across the globe. Alex Karp highlighted that Europe was a little bit slow. If not, these numbers would arguably be a little bit better too. Total revenue growth, these numbers are just off the charts, guys. I mean, there's nothing to say about this business. It's extremely strong, right? Positive operating leverage, which means when the company is scaling, it's improving profitability a lot more than it's increasing expenses. Extremely strong. And here are your US customer commercial counts. Just last year, guys, they had 321 customers. Now 530. That is 65% year over year customer count gain. And here you go. Overall customer count gain over the course of the past year, guys, 45%, and 49% of that in terms of global commercial, as in relation to this one, was only US. So, I mean, the numbers are absolutely staggering for Palantir. Everybody knows that by now. Now you guys know that too. That has never been the question. The question has always been, how much are we willing to pay for this story? Because obviously the analysts have been dead wrong, and Alex Karp literally singled them out today on the earnings call. There's some people up here with a price target of 230, but the average is down here at 160, and you do have some people still stuck in the double-digit range. Now, their EPS is flying over the next 2 years, and revenue is flying as well over the next 2 years. They will be able to almost double the revenue in the next 2 years, and additionally, in terms of EPS, they will be able to almost double their EPS too. So that is not the question. The question has always been, how much, once again, are we willing to pay for the story, right? At $200 per share, where they currently stand in the after hours right now, they have a forward price to earnings of 235, even with a very substantial EPS growth rate, which is still very high, but this is an average, right? You expect these to slow down over time to a more normalized rate. You're sitting at a 7.35 peg. Even if I increase this EPS ratio, guys, to 40, it still would only bring the peg down into the sixes, right? So even in terms of a peg, it's expensive. Price to sales, 87.2. These are the highest numbers right now, guys, in the entire S&P 500. However, once again, there is no other company in the S&P doing what Palantir is doing. That's why it's so difficult to price this story. Even if you take 2027 sales and apply a price to sales multiple to that, you're still trading at a 65 price to sales metric. By all metrics, this stock is expensive. By all technical metrics, in terms of monthly RSI, the stock is overbought, and yet still the stock retains its price up here because of the story. And that's why I've always said on Palantir, since we've been in the mid 100s to now high 100s, I've always said, if you are buying this company, you're not buying it for the valuation right now. You're buying it for the future story and the future impact of the business in terms of what they'll be able to deliver for AI worldwide, both in their commercial segments and government segments. This story, this business is truly one of a kind. Dare I say, it is arguably the AI company out there that will be able to drive the best efficiency gains for every single one of the companies that actually works with them. It is truly a transformational business. You do not see this style of company come around more than once a decade, guys. It truly is one of a kind. The efficiency gains are real. The customer reviews are 100% real as well, right? And they're making a whole lot of money from this in the process. That being said, it's a $500 billion company. Can Palantir at some point in the distant future, into maybe 2028, 29, 2030, maybe over 2030s, can it be a $1 trillion company in terms of their impact in the overall tech landscape and their impact on various corporations and government industries? The answer most likely is probably yes. But am I going to go out there on a limb and say it's going to happen in the next year, in the next 2 years? No, but can it be a $1 trillion company in the future because of its impact, because of its competitive advantages, because of its moat, and because of the management team and the way that they run this company? It's a capital light business with a very small labor force in relation to the amount of money that they're actually generating from this business. The answer is yes. The ingredients for that recipe are indeed there, but it's very tough to put a timeline on it, which is why I say, if you are buying Palantir up here at $200, you have to see that long-term vision. It's like a maybe 5+ year type of play to maybe get above here into the $600, $700, $800, $900 trillion level, right? It can definitely be. And if you had to ask me, guys, I probably do think that Palantir has the ingredients required to be that $1 trillion company. But eventually, the fundamentals will have to catch up to the business, right? They will have to start generating tens of billions of dollars in revenue, tens of billions of dollars in net income if they want to participate in that $1 trillion cohort. And they're growing really well right now. But before they become that business that generates tens of billions of dollars, it will take still a lot more time, right? The next 5, 7, 10 years, arguably. If it happens sooner and this stock gets just multiple expansion, it is what it is, right? But if you don't allow it to have multiple expansion, because these multiples are the greatest that we've possibly ever seen before, right? If you don't allow for any further multiple expansion, right, and only wait for the fundamental expansion, then it will take 5, 7, 10. So that's everything I had to say on Palantir, guys. Big deep dive. I'm not bearish on the company. It's just that if we're investing in the company up here, that's the type of thesis that we have to have. And that's everything I had for you guys for this stock. Hopefully you enjoyed, spent more time on it because of its significance and because of the retail interest, of course. Company number 2 is going to be a bit of a switch of gears. It's going to be HIMS and Hers Health. So HIMS and Hers, the fast-growing medical subscription services company that retail really loves a lot. How did they do after earnings? So if you have a look right here, the company actually popped up 6% after a decent earnings report. If you take a look at some of the numbers right here, you will see they missed on EPS, unfortunately, but they did beat on revenue by about 3.23%. The guidance was a little bit mixed. However, the forward valuation of the company is, at this point in time, somewhat attractive with the forward guidance. Moving on further here to some of the easy numbers, you'll see that their guidance was somewhat lackluster in terms of Q4 sales. They missed the mark by about $15 million. EBITDA as well came in a little bit underwhelming. They did hit their overall fiscal year sales target, and fiscal year EBITDA was a little bit underwhelming as well. However, the growth rates for the company are there. Revenue staggering 49% year over year. Very strong for the business. Subscribers continues to rise right now, 21% year over year to 2.47 million. Now, the monthly revenue per subscriber, a very important revenue metric for any subscription business model, was up 19% year over year to $80 per subscriber, and adjusted EBITDA was up 53%. So the company is scaling well in terms of revenue. It's tough for the business to bring money to the bottom line because they're still doing a whole lot of sales, a whole lot of marketing expenses as well. So I wouldn't say that they've really gotten into their stride in terms of operational efficiency. And you can see that in terms of the EBITDA margins, which are kind of a little bit soft over the course of the recent quarter, right? But they are improving in terms of the long-term trend of the business. Moving on to a bit more numbers here. If you take a look here at net income was actually down 79% year over year because the prior year over year comparison, Q3 of last year, included a $61 million tax benefit. So although it does say it's down a lot year over year, there is a reason for that, and we'll explore that a bit in the earnings slides for the business too. Gross margins, 74%, not terrible, right? But once again, as I said, cost structure of this business is going to fluctuate as they continue to scale. I would not say that this business is fully operationally efficient right now, but it's getting there. It's a journey for this business. The business is still relatively in its early stages. Here's some CEO commentary that we have from the CEO, Andrew Dudum. Now, we're building a platform that gets more personal, more proactive, and resonates with more people as we scale. We're launching new specialties, partnering with healthcare leaders, and making significant progress in establishing HIMS and Hers as a global brand. CFO commentary, we delivered another quarter of strong, profitable growth. Revenue was up 49%. We're confident in our ability to exceed the ambitious 2030 targets established earlier this year. This one sentence right here is arguably the reason that HIMS is up decently in the after hours. The reason being, they previously established this year some forward guidance for the year 2030, saying that they will be able to achieve $6.5 billion in revenue. And if we just take a straight line price to sales multiple and say, well, this company, because earnings, EPS, the company is just flipping EPS positive, right? And when a company is just flipping EPS positive and the EPS numbers are still very small, the best metric for this business, because it doesn't have the most consistent margins, is taking price to sales. And if we just take them at their face value, $6.5 billion of revenue, at a 5 price to sales, it does imply a $30 billion market cap company by 2030. As of today, HIMS is only a $10 billion company. So when the CFO came out today and said, you know what, the targets that we set for long-term 2030, they said that we're confident in our ability to exceed the ambitious 2030 targets established earlier this year. So it may mean there's even more runway for growth for HIMS investors for the medium to long term. Now, if we take a look at some of their earnings slides here, they were actually quite good. Share of total subscribers utilizing a personalized treatment plan, 50% year over year. That's very strong, right? Non-personalized is about 0.9, so 900,000 people. Personalized, 1.6. Obviously, you want to have more people on personalized plans. It just means that the retention rate of the business gets better and better. That being said, the retention rate for the business right now is not all that bad. I penciled it in right here at about 85% customer retention, which is very good. Keep in mind, a lot of their treatments are in a competitive landscape. A lot of the hair loss products, other products such as their erectile dysfunction products. This is not new stuff, guys, right? Obviously, a whole host of other pharmaceutical companies offer these products, sometimes at cheaper price points. So for HIMS to be able to, because of the customer experience, retain 85% of the people that try its platform once, those are very solid numbers. Let's move on a little bit further in terms of some of the things that they're trying to do. So they're expanding accessibility and breadth in existing specialties. We recently reduced prices across personalized GLP-1 treatment plans by up to 20%. This is their weight loss offerings, expanding access to more customers seeking effective weight management care. And you know what's funny though, guys? I forgot to read this one. Yes, the partnership that once was and then got dissolved, resulting in a lawsuit, is now potentially back on the table. They're in active discussions with Novo Nordisk, yes, Novo Nordisk of all people, to offer Wegovy injections and future oral versions via the HIMS and HERS platform. So possibly rekindling the relationship, but they're in discussions right now. We'll see how those go. They're launching new specialties that resonate with both new and existing customers. We expect new offerings in testosterone and menopause care to unlock significant long-term growth opportunities. These specialties extend the reach of our platform to tens of millions of prospective subscribers while increasing opportunities to deepen relationships with existing customers. I will remind you, when HIMS announced their new menopause version, their new menopause line of business, right? The stock that day was up 16 to 18%. Since then, because market breadth has been a disaster and just been selling off things indiscriminately, we've tumbled all the way down here. But initially, that news was very well received by the markets. Moving on further. Allowing subscribers to proactively manage their health with plans to broaden diagnostic capabilities and preventative solutions. We plan to launch comprehensive lab testing capabilities in the near future. This is very interesting, guys, right? So this is kind of like pre-healthcare, right? So they're doing existing things when you need something, but they want to get maybe into preventive solutions, which is a big market overall. And lastly, they want to scale their presence in international markets, as most of their demographic right now is located in the United States. But the total addressable market for this company is quite large if you start encompassing international expansion. We see international markets as a powerful long-term growth lever, representing more than $1 billion in annual revenue potential. Through continued investment and strategic M&A, we believe HIMS and HERS can quickly emerge as the world's most trusted consumer health platform, providing direct-to-consumer access to personalized care to more consumers than any company on the planet. So this company is all about the business model. They do not have any revolutionary drugs of their own, but it's the business model, right? More so an advertising company and a customer experience company than it is a groundbreaking pharmaceutical company. Keep that in mind when you're building your long-term thesis for this business. Nothing wrong with that style of business, but you have to understand what you're investing in, of course. If we move on a little bit further in terms of some metrics here for some financials, you will see that their subscriber growth is really good, right? Very strong subscriber growth. As we said, 21% year over year. Most of their subscribers are multi-30-day subscribers, recurring customers. As we mentioned, the 85% retention rate. Revenue up and to the right. Online revenue represents, of course, their highest revenue driver. They do have some wholesale revenue, and the average revenue per customer is increasing now steadily towards the $80 mark. In terms of their margin profile, as we said, their margins are not the most consistent, but long-term trajectory, they are moving in the right direction. You'll see that year over year, they spend a bit more money on general and administrative, a bit more money on technology and development as they continue to roll out new services. Operations and support up a little bit. The big one that went down though year over year is marketing. Now that more and more people know about the service, they don't have to spend as much money on marketing. They're still going to probably do a big push in the next few years in terms of internationally, but in the US, a lot of it is now word of mouth, social media. So that at least is a big decline here in marketing, which is something that you want to see when the company has already established a big presence overall. And non-GAAP operating expenses, you can see some similar declines. So overall, guys, HIMS earnings were fairly good. They did miss the mark on a few key metrics. They did miss the mark on a bit of guidance for the short term. However, management seems to be very firm on the idea that their longer term guidance in terms of forward revenue estimates for 2030 do still stand and may even be better than previously established. In my opinion, that's why the stock was moving higher in the after hours, because that is what long-term investors and the street wants to hear, that they're able to scale and scale faster than previously anticipated over the long term. That being said, this business is growing revenue and EPS at very fast rates. Through 2027, you're talking about 19.5% revenue per year and EPS 34% year over year. So where they stand in the after hours right now, after their earnings, about 6% higher at $46, you're trading at a 60 price to earnings ratio for a 2026 forward metric. That being said, keep in mind, they're growing EPS at 34% year over year, which gives them a PEG ratio of 1.76. However, price to earnings may not be the best metric to value this company because they've now just recently turned EPS positive. something that we might rely on with a very fast revenue growth rate could be something like a price to sales metric. And at 3.72, guys, I think this is very fair for a company that's growing revenue at that fast of a clip. And as I said, guys, if you just give them a 5 terminal multiple, which is not that rich, by 2030, you end up with a $30 billion market cap. Now, of course, if the company becomes more consistently profitable in terms of operating and net margins, they're able to consistently improve their average revenue per subscriber and their total subscriber count as well. The street might just give them a bit higher than a 5 multiple. Between 5 and 10 seems to be an adequate range for HIMS. 10 is probably the top end if the stock trades really rich for XYZ reason, but the target range of market caps, right, meaning the base case and the ultra bullish case scenario, remains at between 30 to 65 billion in 2030 with the company's own long-term guidance, which could put you anywhere between a 3x from current price to anywhere to a 10, or rather a 6x or 6.5x from current price, which is not that bad at all if we're looking for a bit of a longer term thesis on HIMS. Of course, this company has been very volatile in the past and will probably remain very volatile in the past. I still do have some shares of HIMS, and I will be keeping them to monitor this company's long-term expansion, but it's a very solid business model. They are very good at what they do, and it may just be a company that you may want to look into a little bit more if you enjoy this style of company. And that's everything for our earnings releases today. Hopefully you guys enjoyed. Now, let's dive into some charts, shall we? And we're going to start it off with the good old S&P 500. So the good old S&P currently trading very close to their all-time highs and currently still in a very nice uptrend, but we do know the breadth is a problem. Of course, the line in the sand on the S&P is down here 664, and we do have a bit of a level of support down here, 674 down to about 668. So in the case that we have to fall back a little bit, we do have some support, but you can tell the futures market right now just not having it, right? We've been getting progressively weaker here over the course of the past 4 or 5 days. And trust me, there is no news right now happening in the after hours, just stocks continuing to kind of pull back. And you're in a bit of an awkward scenario for the S&P, guys, because breadth is the biggest concern right now. Of course, percentage of stocks above their 20-day EMA is at a very low read, right? 39% only of stocks are above their 20-day EMA, which has been achieved earlier in October, and the last time was in August, and before that was the tariff. So we're at a very low read right now. Percentage of stocks above their 50-day EMA, you would have to go back to the tariff sell-off to find such a low read of only 39% of all stocks in the S&P above their 50-day EMA. And lastly, percentage of stocks above the 200-day EMA, that's at 53. Not terrible, but we're losing more and more by the day. And you know what my biggest concern is when we have a lot of breadth like this and the market is being carried by a few names? The names that are carrying, are they themselves extended from their EMAs? Well, we'll cover these a bit later, but I'll just go over them quickly right now, right? Where's Apple? Apple used to be all the way down here, so Apple could provide some lift if ever we were missing some big tech corporations. Where's Apple now? Very far from its 12 EMA. Amazon was left behind for a while. Where is Amazon now? Extended from its 12 EMA. Google used to be lagging behind a little bit, so we could have used it for some price action support in the S&P. It's a big name in terms of market cap. Where is Google now? Very extended from the 12. Meta used to be extended from the 12, and now Meta can possibly provide some price relief, but Meta has its own suite of problems going on right now, which we'll talk about. Microsoft, where's Microsoft, right? Still extended from the 12 EMA, right? And not a cheap valuation either. Netflix can maybe provide a bit of relief, but it's not the biggest company in the market. Netflix had that same problem here, where it needed to consolidate, right? And now finally, NVIDIA. Where is NVIDIA, right? And even NVIDIA used to be consolidating down here, and we could have used NVIDIA for a bit of price action support for the markets to lift the markets. If ever we were weak a little bit, you could count on good old NVIDIA after a phase of consolidation to maybe start pumping a little bit and lift the markets. That has already happened. So as you can see, many of these names, the Mag 7 names, are somewhat extended right now, which gives me a bit of caution and a bit of pause, right? If we are weak in the overall markets, what's going to happen, right? Usually what happens is when big tech takes a breather because they've ran a lot, you would expect the rest of the market to be there to pick up the slack. Is the rest of the market going to be there this time if big tech falters, or are people just going to refuse to bid anything other than the AI stories still in this current market? And then when the AI stories have their own pullback phase, Well, are people just going to stop bidding the market altogether and saying we ran too hot, too fast? That's why the narrative right now in the market is somewhat cloudy. And that's what we were saying in the Saturday video as well. On to the QQQs right now. Still a very nice casual daily uptrend overall and no red flags. We have not lost any time frames, but we can see the pressure and the uncertainty building a little bit right now. Line in the sand remains at about 600. To lose the daily uptrend, you can either do that in one shot or two clean shots. If you lose this low right here, right, arguably going to go into a daily downturn right away. So we'll see what happens. Moving on to 610 down to about 607 is your previously established resistance, which is now support. And the weekly uptrend remains very healthy. However, we are extended from the 12 EMA. We are very extended from the 200-day EMA as well. And the monthly time frames show the same thing. 7 months of nonstop rally. You could eventually get a bit of a pullback if any one of our bearish catalysts kind of plays out, right? The QQQs do it all the time. They run hot, they pull back to the 12. They run hot, they pull back to the 12. They run hot, pull back. You guys get the idea, right? The market moves in waves. We have not had a down wave now in quite some time. I understand we're in an AI megatrend and you do have some equity acceleration happening right now, but still, when you get too far, the risk does not go down. The risk goes higher, right? That being said, moving on to financials right now. Financials still soft on the day, 0.42% for the downside. The daily bulls have lost their daily uptrend and now right back into support. So we are now trendless on financials. Still consolidating. Line in the sand for the weekly is 51.52. Lose this, and one of your major sectors in the market goes into a weekly downtrend, something we have not seen in the last 6-7 months. It's been a weekly uptrend the entire time. This has to be notable to you. Weekly downtrend means more monthly consolidation, maybe down here in the confines of our support range, which is 52, down about $50 into that good old 12 EMA, which the bulls have done a good job holding on to other than the tariff unwind, of course, looking for a monthly higher low for further trend continuation, but a lot of financials have been nowhere to be seen. The banks have been doing good, but where are the credit card players? Visa, MasterCard, great earnings, nowhere to be seen. Insurance corporations such as Berkshire, right? Nowhere to be seen. Allstate, you can look at that one too. Nowhere to be seen. Chubb, arguably as well, nowhere to be seen in the last year worth of trading. Brown Corporation, another big one, nowhere to be seen and net down. PGR, same thing, nowhere to be seen. We talked about why insurance is down because there's a normalization in premiums. They pulled forward a lot of pricing power here with inflation, and now they don't have it anymore, right? So that being said, insurance is down, but not only them, financial data players, SPGI, same prices last fall. Moody's Corporation, arguably the same prices as last fall as well. So several big segments of financials are just missing in action right now. And you cannot have that if you want overall financials expansion. Keep that in mind. On to healthcare right now. Healthcare also struggling a little bit today, right? It was green, but not the strongest candle. Right now, what the bulls are looking to do, looking to establish a daily higher low and go for the daily uptrend continuation and try to get above this range of resistance, 148 down about 145, looking for the continuation of the weekly uptrend. It doesn't look too bad, but this is a very big level, guys. A very, very big level, right? And you're going to need someone else than Eli Lilly to do all the heavy lifting. If you take a look right here, right? I'll move myself over. Eli Lilly has been doing all the heavy lifting. The other pharmaceutical stocks, not too good. Health insurance players, definitely not there at all. And the rest of the market, medical devices haven't been doing too bad. But look, even over the course of the past 1 week, Eli Lilly is doing all the heavy lifting here. It's kind of like big tech heavy lifting the market, right? Eli Lilly is doing most of the heavy lifting here. You need more breadth in healthcare if you want to start cracking that level. So keep that in mind as well. If you get rejected again and you do not find breadth within the sector, well, you will come down for a bit of a monthly higher low, and then maybe we might have to have another stab at it. Keep that in mind too. Moving on to SMH right now. SMH up 0.53%, but down in the after hours. Taking a look, daily uptrend shows that nothing is possibly wrong just yet. Still looking for a daily higher low, anything above 332, looking for a daily higher low. For possible further trend continuation, maybe the fallback zone could be something like a 346. Not too bad. Previous resistance could be previous current support for the markets. That being said, if you take a look at the weekly timeframes, very extended. Extended on the weekly RSI, extended in relation to the weekly 12 EMA, the monthly as well. Very, very extended from this monthly 12 EMA. Overbought conditions, and semiconductors do this too, right? We can run hot, but eventually you get something that pulls you close to the 12 EMA. Usually you do not get this extended without some pullback. And now that NVIDIA has ran a lot of things, a lot of other things have ran substantially, right? Micron, look where Micron is. AMD, look where AMD is, right? Strong monthly candle closes. We won't take that away from them. LRCX, another name that's all the way up there too, right? Some of the biggest players have ran really, really hot over the course of the past quarter. We will see if that can continue. But if there is a bit of a pullback across semiconductors, you're going to feel it, and you're probably going to feel it a little bit fast because a lot of them are very extended. Now, moving on to the Russell. The Russell also struggling a little bit today, but we know the Russell is a combination of many different sectors of the market, right? It has some, 17, 18% exposure to financials, that much in healthcare as well, industrials too. The Russell is not just a whole bunch of unprofitable tech companies. It's a representation of a market, the market demographic as well, right? A whole bunch of different sectors. That being said, daily uptrend, the bulls are looking to protect. Line in the sand is down here, 240. Lose 240, you lose the daily uptrend, and you might just be going into weekly consolidation. Line in the sand for the weekly is 238. Lose 238, and you lose the weekly, and you might be going into the ever so elusive monthly consolidation that we've been talking about now for the past few weeks. Just pay attention to it. If your markets unwind, the Russell's going to come down too, maybe down into here, 232, down about 225. Previous resistance, current support, and the monthly 12 EMA. Very nice little good old breakout, retest and run, or possibly the cup and handle for the run into end of Q4, maybe 2026 as well. So please keep that in mind. Consumer defensives remain extremely weak. Apparently, staples are worse off now than they were during the massive tariff sell-off. Funny how that works, isn't it? Daily oversold conditions on some staples right now possibly could be interesting to maybe position into staples if we have a rotation from risk on to risk off in the market. Staples probably will catch a bid, but no bids as of yet. That being said, they are into support. If we lose this, you're coming right down here, 74, down about $70, which are some of the support lows from 2023. Utilities overall, not having the worst day in the world, but still in the context of this daily downtrend, just looking for a lower high to lower low until you get the daily uptrend reversal. At that point, you'll know the weekly consolidation is finished. Now, the weekly bulls are doing a great job of protecting this weekly uptrend. A lot of space still, anything above 82.5, looking for a weekly higher low. So you cannot call this the bottom. They're reacting from the 12. You can't call this an actual structural bottom or a tradable bottom until you give me a time frame reversal. Then we can make some plays off of this being the weekly low and go for the expansion. As of right now, another sector in consolidation mode, and real estate as well is in consolidation mode too. Down 0.17%, but a green candle to finish the day. Not terrible, but still buried in the confines of support. This is like a year and a half worth of support at this point too. I mean, real estate hasn't moved, guys, in like over a year, right? Just consolidating. And still the reason for that is because with what Jerome Powell told us last week, that the rate cuts in December are not a foregone conclusion. Your rate cut odds for another 0.25% interest rate cut are only at 63%, right? Prior to the Fed meeting, I'll remind you, they were at 94. So the market is currently unpricing the ability for a December rate cut. And as a result, a lot of your interest rate sensitive sectors, such as real estate, have been coming down hard over the past week since that meeting. And you can see that from the weekly performance on your industrials and a lot of interest rate sensitive sectors as well. So please keep that in mind. Moving on to the VIX. The VIX not moving higher today. For the VIX to really start to skyrocket, guys, you're going to need to lose big tech, right? If you continue with this weak market breadth and then big tech starts selling off without any big macro catalysts, then you will start to see a spike in the VIX, and that will really give us some better entries on selling options, more specifically selling put options under the market on our favorite companies. As of right now, the VIX remains a little bit muted. In terms of the yields, you will see that the yields since Jerome Powell spoke have been up, daily uptrend in the context of a weekly downtrend on the 10-year yields, but just pay attention, right? We may just be a little bit sticky here, maybe through the month of November, even into December, pending that possible rate cut. And the 20-year yields show the exact same thing. It is a nice weekly downtrend, but we might just get stuck here above 4.5, 4.6 on the 20 until we get more confirmations that that rate cut will come. And as a result, your bond trade possibly peaked a few weeks ago, and now you might just be relegated to a bit more sideways action in the market, unless the whole market starts to unravel in a very rapid fashion. You might be getting a bit of a fear bid on the bonds, right? But it won't be because there's interest rate cut certainty, that's for sure. Moving on to gold right now. So gold still remains a little bit soft. Daily downtrend right now, lower highs, possibly established right now. And we may be looking for a little bit lower on gold. Your line in the sand remains 3,900, right? This was a decent bounce by the bulls, 50, 618 almost. but it doesn't guarantee the possibility of a daily trend change and establishing a weekly low already. In the event that the short-term bears remain in control and push us a little bit lower, the first line that you should be looking at is the 12 EMA, something the bulls have been defending over the course of the past year of trade, right? And that right now is about 38.58. Still no trades on gold for me. I'll be waiting for a bit more tight price action. I want to see them establish some form of a tradable range or establish some form of tradable bottom. As of right now, it's just, bearish bias. Moving on to Bitcoin right now. Bitcoin really not having a good day on the Monday session, down 3.6%. Still doing a whole lot of nothing though. Yes, it's a new daily downtrend. Yes, the weekly has been very soft, but I'll remind you, we're just trapped in a range, right? The range highs are 120 down to 115, and the range lows are 107 down to about 100,000. It just goes to show the monthly time frame holds all the keys. Just monthly consolidation again for Bitcoin. It's been doing it for 4 months. We are coming into support, and the 12 EMA is down here at about 100,000. Decent location to accumulate. If you are a long-term Bitcoin bull, you kind of want to be accumulating these consolidation phases on these assets. Into Ethereum, same concept. We talked about this last week, how the bulls were trying desperately to defend this 4,000 to 3,700 range. Now we've lost it, right? Big candle closed below. Daily downtrend resumes. Weekly downtrend was always in motion, which is why we had somewhat of a short-term bearish bias, right? So this one right now, guys, it's clear as day, right? Weekly downtrend, another weekly leg lower, and as a result, your monthly consolidation is not finished. We talked about this on Saturday when we noticed the monthly candle close was not very strong, and I was saying decent level to accumulate some Ethereum if you believe in the long-term thesis, but save some buying power because you might just be heading to the lower bound of support for the good old 50% retracement on the fibs. So keep that in mind. We're now breaching structure, moving towards this lower bound. And as a result, we should be able to DCA down there if they do bring us down a little bit further. But short-term timeframes, definitely looking that that is a distinct possibility. That is everything we had for the overall market rundown. Now let's get into some big tech names. Now, we'll go through these big tech names, guys, and I'll give you a little bit of my thought process when I'm looking for trades on these names and when in the market environment is good to actually be looking at these names for some bigger trades, especially some of those call options, right? So Apple right now, we'll just run through the price action. I'll run you through my thought process, yeah? Apple is very extended on the monthly. The monthly time frame looks great. We had their earnings last week. Their earnings were very good. Their guidance for Q4 was very good as well. That being said, they are sitting at a bit of an extended valuation right now, which means the company is trading relatively rich. Additionally, the price action looks solid. Daily uptrend looking for some daily higher lows. Anything above 255 looking for a new higher low, maybe to continue the trend. And the weekly also doesn't look so bad. It is a very gorgeous weekly uptrend, but we're extended from the 12 EMA. A little bit overbought on the weekly timeframes as well. That being said, is Apple and I swing trade up here? No, because we keep saying, right, the market breadth is soft. You know that only a few players are leading most of these gains. As a result, there's two different types of Apple trades. One of them was the one that I highlighted about a quarter ago, where the market breadth was very strong. A lot of the big tech names were doing really well. Overall, the market was doing very well in terms of broad market strength. But you know one company that was lagging behind 20% year to date, where the valuation was quite manageable? It was Apple. So Apple was trailing the S&P by a big margin, trailing the Qs by a big margin. The market breadth was strong, and Apple was one of the only players that was left behind. That is when you want to be trading something, not when Apple is extended. It's one of the only names helping hold up the indexes, and you have very low market breadth. You see how the contrast is between those two trade setups? One comes with a better risk to reward ratio than the other. Keep that in mind. AMD, similar concept, right? Now, AMD has earnings tomorrow. The stock is probably going to move 7-8% after earnings, so we can't comment too much on the short-term price action, but be very careful if they come down for some reason after earnings. I think they'll have good earnings. But you know, guys, sometimes that good earnings doesn't really mean anything. You just saw Palantir have some of the best earnings that they've ever arguably had, and some of the best earnings that any software company has possibly ever posted, but the stock still went down, didn't it? So I am expecting good earnings from AMD, but you know, the price action movements will be a casino. I would love to see them go higher because I hold a lot of AMD. If they come down, watch the line in the sand down here, 225, we'll cover it after earnings. But it's the concept of the trade as well, right? AMD had a really strong rally into August and then kind of tapered back for about 5, 6, 7 trading weeks right there. In that time, Names like ASML had a very good period. Names like LRCX had a very good period. Names like Micron had a very good period, right? The one that was kind of lagging behind a lot of that pack was AMD. And at that time at 160, it had a very good valuation, right? And we were just pending for the fill of the cup and handle, back testing some nice supports. It was around the monthly 12 EMAs, and we could structure a very easy trade thesis for the next leg of expansion. Now, you've already had the next leg of expansion. AMD is one of the names that is helping hold up the semiconductor industry, but helping hold up the entire market. As a result, when you have low market breadth, and this is a name that's helping hold it up, do you want to put all your cards in this one name right now at an unfavorable short-term risk to reward ratio, or would you rather do it down there? This is what I mean, guys, right? It's all about the context of the trade in relation to how the trade is performing to its sector peers, but also how it's performing in relation to the rest of the market. When AMD was here early August, when we took these call options and we're selling puts, the market breadth was still good. And AMD was one of the names that was kind of lagging behind in terms of like 5, 6, 7 weeks. As a result, it was a very strong trade. Right now, dubious, right? The long-term thesis for AMD is still very clear. I still believe that in late 2026, early 2027, if they just execute, right? They just execute on their EPS guidance and on the revenue guidance, they should have no problem. But short-term positioning, it's a very, very greedy long right here. Moving on to Amazon right now. Amazon was kind of late to the party, right? But we established a similar thesis on Amazon. Amazon had been lagging behind the overall tech sector, and I kept bringing it up for like 2 months at the time. I kept saying, guys, you know, all the rest of the names on big tech are up like 20% year to date. Amazon was the only one that was like flat year to date. And I was saying, if they just have a good quarter, which they should, and justify AWS growth and reiterate AWS growth, they should be doing pretty well. They were lagging behind, right? Monthly was a nice monthly consolidation, back testing the 12. That was a very decent trade setup, and that's where we positioned, and we were playing it very heavily and adding some shares. Up here, when Amazon has been responsible for holding up the index of the past week or so since earnings, where the whole rest of the market, unfortunately, is dying, is Amazon the type of trade you want to pile into up here? Well, the answer should be clearly no, right? There's times to take these trades, and there's times to say, listen, the environment is a bit cloudy right now. Do I want to pile into something that's ran this much in a short amount of time since earnings with a bunch of gaps behind? Because if the market unwinds, they're going to take Amazon with it, right? But however, the short-term price action, if you just look at this, I mean, it is a daily uptrend. Earnings were fantastic. I love their earnings. We covered them on the channel last week. Even at 250, the stock wasn't that expensive, right? So believe me when I say, if they do pull back to the 230 to 220 region, which would be a nice back test of prior resistance, that will be the future area to position if the SPY, the QQQs fall off a little bit and they take Amazon with it. Well, believe me when I say, with the earnings that they just had, I'll be buying this one on a nice technical back test because of its longer term and medium term fundamentals. Moving on to Google right now. See, guys, I could just do these videos in 20 minutes and say, you know, RSI's overbought, supports down here, etc., and just move on to the next chart, right? But it's the context, identifying when we can deploy heavy amounts of capital into these trades, scale in with a good risk to reward ratio and a good thesis. That's what matters most when you're trading the markets, right? Not so much supports here, resistance is there, next chart. Supports there, resistance is there, next chart. That doesn't do anybody any good whatsoever, right? So hopefully you guys enjoy the context because the context matters a lot. And the same thing is something like Google, right? We could talk about Google all day. We covered their earnings, right? And we said up here at 290, the stock was very fairly valued, right? 27 forward priced earnings, 1.8 peg. However, technicals wise, we're extended from the 12 EMA. The weekly time frame is very overbought right now. The daily time frame is also very overbought right now. So if we're buying this one for a long-term thesis and we're DCing with our paychecks until it's overvalued because we have a timeline of 5 to 10 years, that's fine. But if we're looking for short-term swing trades, this is a very greedy long. Why? Because Google's been one of the names that's been helping hold up the market. The time to position heavily into Google was back here when Google had a whole host of short-term narratives against it, when it was trading at a 16, 17, 18 forward price to earnings ratio, when nobody wanted it, and when Google was lagging behind a market that was very broad, its sector peers were outperforming, and Google was lagging behind. That's where you can build a thesis and build some positions with some time and some size. Building those same swing trades up here with the same risk to reward and the same size is somewhat not feasible. Do I still love Google as a stock? Absolutely. But you got to kind of call the cards on the table for what they are, right? You got to say a spade is a spade. Daily uptrend is very nice. Not going to take that away from them. Weekly uptrend is also very nice. Pay attention to any pullbacks, good opportunities for some long-term buys. But overall, the stock is very extended right now across all the time frames. What you want to do as a trader, not as a long-term investor, because that's different. You can just DCA, right? As long as the valuation isn't crazy. But if you're trading the markets, guys, you want to find the perfect combinations, the confluence between a good technical pullback setup and good fundamentals. That's when you know you have an A+ trade and not just a trade with a few things that are wrong. Like, see, Google is good fundamentally, but the technicals are overbought right now. As a result, which one do you trust more for a short-term swing trade? It's not that obvious, is it? When we're down here, not extended, the fundamentals are really good, and the price action is really good, well, then it's a very easy trade risk to rewards in terms of risk to reward, isn't it, right? So you can see how that matters a lot. The confluence of fundamentals and technicals is what gives us the best trade entry sometimes. Talking about Meta down 1.64% again. Daily uptrend, of course, clearly lost, and the short-term bears are in full control. Oversold in the RSI, 25.5. Weekly timeframes, weekly downtrend is continuing right now, coming into a very small area of support, 640 down about 623. That being said, if you breach this, you're going down to the big one, the big boy down here, 600 down to about 561. Now, right now, Meta, I mean, we did this after earnings, right? We said that it was a low 20s forward price to earnings, a 1.7 peg, and a 7.5 price to sales. All very decent numbers. But you know, right, this is going to start to be a very attractive trade, like Amazon once was, like Apple once was, like Google once was as well, like Microsoft once was when it was consolidating this entire year back here, right? When NVIDIA was consolidating over the course of the tariff sell-offs. Now we're finally starting to see some nice confluence. Low forward multiples, and also a very nice technical setup. I'm not saying Meta is going to turn around instantaneously, but through this monthly time frame bottoming out process, that is when we want to build some of these swing trade positions that we can carry through the next few quarters, especially for trading leap call options. Pay attention to this monthly time frame because the daily full bear control, the weekly full bear control right now. You need to wait for the bulls to tell you when they are ready to stop the bleeding and establish new daily uptrends. So I'm a big fan right now of doing two things: long-term Meta shares, but also starting to slowly build into some of the leap call positions as we move into low valuations, oversold short-term conditions, and decent longer-term price action. See, now we have a better setup on Meta than buying it all the way up here when we are extended on the technicals and extended on the valuation. Hopefully that makes sense, guys. The market will always offer you high-quality setups if you just wait. That's why I say, guys, you never have to chase the market. You'll always find some of the Mag 7 plays with perfect setups to where the technicals and the fundamentals line up. Right? You'll find them. They rotate between each other for different reasons, right? And even when we're looking at different names as well, right? You never have to chase. There's always going to be something where the stars align. You get a good setup, the fundamentals are cheap, forward growth of the company is good, it's a profitable business, and the technical pullback is also good as well. So watch for those setups. Don't do a shotgun style approach of trying to trade everything under the sun. Wait for the A+ quality setups and you will improve your hit rates for your trades. Moving on to Microsoft right now. Microsoft was like the same thing, right? There's a time to build big Microsoft positions when it's consolidating for a year with very cheap fundamentals at that time. Back here, Microsoft was trading under a 34 price to earnings, consolidating for a year and going into its 12 EMA. That was a great time to be building some long-term shares and some longer-term leap call options. All the way up here, when we were slightly extended from the 12 monthly overbought conditions, it's not the same setup. Can it still work? Yes, but that's not the question. Is it an A++ setup? The answer is no, because although it's a very solid company or whatnot, right, the monthly has just not pulled back enough. That being said, the daily trend, I'll give you guys the levels, right? But we're spending time today on the context of building trades, large trades, long-term trades, yeah? 518 down to 502, because we can play, we can talk about daily, weekly call options, things of that nature, but that's not what you guys are here on the channel for, right? You guys are here for the higher conviction, big trades that allow you to scale your account rather than sniping weekly call options or whatnot. There's nothing wrong with that, by the way, right? But you guys know my style. If you're watching me, my style is going for the A+ setups that come around once every now and then, and you hit them with conviction and you hit them with size, right? And with time on the contracts too. That being said, the daily is not terrible. Line in the sand is down here, 507. We've retraced a very large amount. So pay special attention. If the bears make it through this area, it's not going to look the best. They had good earnings. Nothing bad to say. They had really strong earnings, right? But now we're giving a lot of that back. Line in the sand on the weekly is 505. You lose 505, you lose this new weekly uptrend, and you might just be heading into a bit more monthly consolidation. I would love to find Microsoft around the 12 EMA, and thereafter, we might be able to build a bit more of a higher conviction trade, better levels, better pricing in relation to forward multiples as well. And maybe, just maybe, we end up in a situation, if the market's completely unwind, you maybe find even daily oversold conditions. Lining up all of these things at the same time, that's what gives you the better risk to reward setups. Moving on to Netflix right now. Finally, Netflix pulling back, and they have a stock split coming up in the next 2 weeks. It's going to be an interesting play, in my humble opinion. Daily gotten crushed after earnings, right? Daily downtrend. The bears are in short-term control. Resistance above us, 1150 down to 1100. On the weekly, you are also in a weekly downtrend. Daily is not oversold just yet, but push us down a little bit more. We're already into the 12, push us down a little bit more. Historically, has it been a good time to buy Netflix around the 12? Well, better than when it's super extended from the 12, right? So now that we're here 5 months later and the fundamentals haven't changed, they're still as strong. Netflix is now trading at 1100. It's trading at closer to a 30 forward price to earnings, closer to a 1.6, 1.65 peg. This is done at 1180. So just take like 10% roughly off of these numbers, right? With still very strong fundamentals. Well, now we're getting into kind of like A+ trade style setups, right? Where we can start accumulating some positions between 1,100 and $1,000. And now we know, perfect. We've waited for consolidation. The fundamentals are still very strong. So now we can start building into some of these positions with some longer term shares, or maybe when the stock splits, maybe we can explore the possibility of some leap call options for deep 2027 and trust the business's fundamentals and trust that we have achieved a very decent level of price action pullback too. Makes sense? Hopefully it makes sense. Moving on to NVIDIA right now. NVIDIA, not too bad. Bit of a double top right now. Pay attention. Daily higher lows are down here. 201.50. You lose 201.50, you lose the daily uptrend, and you go into a bit of weekly consolidation. The weekly bulls working with a ton of space, though. Beautiful weekly uptrend. The line in the sand is here at about $177. So not looking too bad overall. And with NVIDIA's updated guidance of $500 billion in the next 6 quarters, at about 206 right now, you're standing up between a 1.3 and a 1.43 peg. Not too bad. That depends on which EPS growth rate you use. I use the range here just to give you guys a range of peg ratios, but either one of these is still relatively cheap for this business overall. And I would be a fan of waiting for some further pullbacks to maybe sell some short puts into the like 190 to 185 pocket right down there. On the monthly, we are somewhat extended as well from the range. Monthly uptrend is very hot right now. Any pullbacks could be a very nice opportunity to play NVIDIA moving forward. Moving on to good old Tesla. Tesla up 2.59% today. Not too bad of a day at all for them. Looking pretty good. Daily uptrend. The bulls are looking to kind of break out. This, I mean, for all intents and purposes, right? This on higher time frames, it was a weekly bull flag, and we commented that on a lot. We commented on this a lot recently, right? Consolidation at the top end of a move looks pretty good for some possible forward expansion. Line in the sand on the weekly is 410. The bulls will be looking to go for the infamous $500 beyond all-time high breakout. They're looking good, but trust me when I say, right, if the SPY and the QQQs pull back hard, do you think Tesla's going to get up there? Probably not, right? Tesla was also one of those companies where, let's be honest, at $1 trillion, it holds its weight in the index, right? It's not nothing. And previously it was lagging. We had a nice accumulation right here. We talked about this for a while with a bullish leaning bias because the overall market was bullish. And then we got the pop, right? This was the area where we were talking about some better duration swing trades, right? Positioning here for some call options for the breakout is a very greedy trade. I'm not saying it's not going to work. I'm just saying it's very greedy, a lot more greedy than playing a tightening range into a massive area of support for a stock that was lagging behind the indexes a little bit, waiting for the AI pop, right? So keep that in mind for context for Tesla as well. Moving on to good old Palantir, we covered it, of course, during the big earnings presentation earlier in the video. That being said, right now, we're going to be a bit lower moving into tomorrow. We had a nice space here of consolidation. So at this point, higher lows are 170, let's call it. So any move lower looking for some new higher lows for possible further trend continuation. We will see, but this is very good support down there at around 186. The weekly is going to show similar characteristics. Beautiful weekly uptrend, looking for a bit of a higher low. 186 would be the mark that I'd be looking at. We already covered the valuation earlier on in the video. This is just for technical levels of pullbacks overall. Moving on to SOFI right now. SOFI up 3.2%. Nice backtest here. Daily uptrend was nice. We talked about the backtest last week to where when we backtest in here, it's a nice area to sell some put options down there. Not too bad. And at $31 overall right now, guys, where we stand, the valuation is not terrible, right? You're looking at a forward valuation here of about a 1.22 peg and 8.66 in terms of price to sales. Not so commanding whatsoever. SOFI, not looking too bad in terms of the daily, right? Just pay attention though. Line in the sand is now 28.55. Lose this, you lose the daily uptrend, and you go into a bit more weekly consolidation. Good thing the bulls are working with a ton of space. Anything above 25, let's call it, looking for a weekly higher low. If you pull down a little bit more, decent time for be adding some shares to the long term and maybe selling some put options down there, which is my preferred level. 2021 highs, big area of support right now. Nice area to be selling some puts. And now lastly, but not least, before last, Uber. I mean, Uber has earnings tomorrow morning. So it's like, what do you want me to say, right? Stock's going to move 6-7% after earnings. 7% higher, you're cracking 100. Blue sky breakout, all-time highs. 7% lower, pay attention. You'll be right back here into the confines of support, 93 down to 90.5. We covered this on the top 5 options plays. If you pull back with big volatility tomorrow, good chance to sell some put options down here in the mid-80s because I don't think Uber is going to put up bad numbers tomorrow, but if for ever which reason the market takes them down anyways, they're trading at a very decent valuation down there, low 90s, right, into high 80s, 1.17 peg, good free cash flow yield. So if I can find some short put options down there, could be very decent, but we will see what we get on Uber tomorrow morning. Tough for me to call which way it's going to break. I think they'll have good numbers and good KPIs in terms of mobility, deliveries, and monthly active users. But of course, earnings are a casino. It can go either way. Moving on to TSM right now. TSM, once again, failing at the top right there. But TSM had some crazy news today, which was this one right here. TSM to launch 4-year price increase strategy amid chip demand. There's just too much demand, and as a result, they feel that they can take it upon themselves to raise prices 5-10% per year from 2026 onwards. So that was some very good news for the company, and this is why I enjoy investing in this company so darn much, because in my opinion, they have so much pricing power. There is nobody that does what they do. That's when you really know you have a big moat and a big competitive advantage. But the price action right now, stalling out a little bit. It's still trying to go for a daily uptrend. If you get rejected, you might just go into some awkward, very wide range, kind of like we did all the way back here, right? So the price action a bit unclear on the daily. It still looks okay, but still unclear a little bit, right? That being said, on the weekly, if you get any pullback, especially with that bullish news, the fact that we covered their earnings, they had phenomenal earnings. Now we can confirm that they have pricing power for the next 4 years, which will be great for their net margins, great to protect these revenue and EPS growth rates as well. And as a result, the valuation of the company is still somewhat attractive up here, even at the $300 range, which means if they line up the stars, and they give us the nice weekly pullback with overall broad market consolidation, and we get a better valuation and a pullback on the monthly, because now it's extended towards maybe like the mid 200s, like 270, 260, 250, and we just cool it off a little bit. That is possibly when we can line up the stars and find some time frames that get cooled off, valuations that get even more attractive, maybe some short-term oversold daily conditions if they really start unwinding quickly, right? And that is when you can structure a longer-term trade thesis with a bit more size, rather than playing a breakout out of something that is already stretched and just saying, well, yeah, but it's still cheap. You know what I mean? There's a way to structure this. And my favorite style of trade, I'm not telling you guys that my way is the best way. I'm just saying that I optimize for risk to reward setups, and I want a confluence of two things. I want good fundamentals, but I also want a good technical setup at the same time. Hopefully all of that makes sense. And that concludes our overall market video for our market rundown on our big tech names. Hopefully you enjoyed. Now let's spend some time on our biggest gainers and losers of the day. Okay, so talking about some of the biggest losers here. ASTS, am I interested? Am I not interested, guys? Probably not interested unless we kind of come down here to a more manageable area, which would be like mid 40s, maybe with some big volatility to kind of get some short puts in. But as of right now, not very interested. The monthly timeframes are very extended. I'll go through these very quickly and just tell you where I might be interested. For me, it's mid 40s. Anything higher, I'm not really interested. SMR, same concept. We played this one when it did come down previously in the last few weeks, down to 30 off some big sell-offs, right? If we come down here again, maybe you find me selling some short put options under 30 into a more manageable area of overall support and into an area of larger monthly consolidation. As of right now, not too interested up here, especially with the way the markets have been going recently. Navitas, a fan favorite that I always get one person in the comment section. And I appreciate you guys asking me about these companies in the comment section. Down 9% on the day, but that's not where it ends. Down 12, 13, 14% in the after hours. I was saying that up here, guys, it's a very risky proposition to chase these things. It comes back to the analysis that I was doing for the big tech names, right? I want a nice area of technical support and also somewhere the valuation makes a bit more sense, right? Now, it's the valuation of this company is stretched because, of course, they won't be making much revenues. They have the NVIDIA partnership, which led to the hype, but truly revenue scaling starts 2028. For the next year and a bit, they have nothing to show for all this price increase. That being said, up here, a few members in my Discord asked me like, listen, I'm up a lot of money. Is it a good time to sell? And I was saying, well, technically, yes. Like you're overbought on the technicals right here on the daily, overbought on the weekly timeframes. Can it run more? Sure, but take your profits. These things move in waves. And now you get your wave down back into $10 to $8. So maybe if you've been interested in Navitas and you have a long-term thesis, maybe now they're providing with you with the entry that if you just would have been a bit more patient, you might have just gotten anyways, right? These companies run very hot and then they consolidate in a big way, but that shouldn't be news to you guys. They've done this several times in the past as well. So this area could be a little bit interesting overall. Critical minerals still remains a very tough trade. I mean, it's a tough trade because of this, right? The Trump deal that was just made from China, which suspends the new rare earth export controls for a year. So obviously, when you bid these stocks up tremendously after the China tariff incident 3 weeks ago, well, now you're unwinding all of these trades. You're unwinding that one. Look at USAR coming all the way back to reality. I'll remind you, this is where I positioned for my initial longs with some of the Discord community members, right? And a lot of members took profits up here because we were saying like, listen, it's just blown past proportions. You're getting the perfect exit narrative with the Trump tariffs. Narratives are about like 2.5 weeks ago, right? But just be very careful going into that negotiation meeting in South Korea. And now you see the aftermath of that. Quadruple use, same concept, right? Now losing structure, solid company, but losing structure. They just reported earnings today, right? Today. So that being said, company is currently down, a decent amount, 13% on the day, and pulling back from the overall narrative, right? And even more a little bit here in the after hours, down another 10% down to 16.15, now to a more manageable level. Where would I like it? You got to give me like low 10s, man. That's where we were playing it before so many times back here. Profit taking into strength, into volume, into retail bag holders, and now the narrative flips and everybody gets trapped and everybody's underwater. Critical minerals. Will there still be some infrastructure requirements for the longer term for the US? Of course. But what you did right here is you pulled forward an entire, years worth of a narrative really, really fast. So I'll be patient on these ones and playing the pullbacks. BMNR, we can talk about it a little bit. BMNR, for me, is a bit of an accumulation trade, right? Going for the next leg up on ETH. Here, down to like low 30s is kind of where we would want to be accumulating some shares of BMNR. If you believe in Tom Lee's thesis, if you believe in what JP Morgan CEO Jamie Dimon said last week with Larry Fink of BlackRock, saying that crypto stablecoins will be used in almost everything, and we're building our own backend with stablecoins. Tom Lee's looking to acquire 5% of ETH. If you just take that to the bank, he should be increasing his exposure a fair bit more, about 60-70% more than he currently has right now. And also, if the price of ETH goes beyond 4,000, well, you have a double lift condition here for BMNR. Tom Lee adding ETH to the treasury, but also ETH price appreciation. So this is the time to accumulate, even though it feels kind of rough right now. NBIS, super solid company, high quality company. But I'll remind you, this one too might just move in waves. Very extended on the monthly, guys. We've, once again, a lot of these names, this one, Iris Energy, you're pulling forward a lot of revenues, right? And you know how fast these things can go. You literally just saw 2 weeks ago a 30% pullback in like 6-7 days of trading. So be patient with these names, right? They will eventually give you some possible monthly pullbacks, and I'll be patiently waiting for them. If they just keep running and running and running and running, perfectly fine. If you guys have positions from down here, if you have a long-term thesis, there shouldn't be a reason to sell, but positioning here for some short-term breakout swing trades on low market breadth is a little bit very greedy in my humble opinion. So keep that in mind on names like NBIS and other names as well. I mean, if you move forward into it, CoreWeave as well. CoreWeave for me starts to be a buy back down here into the lower 100s. It doesn't look like it's so much. From the bottom to this top right there, that was like a 75-80% move. Now we are just cooling off some of the time frames. It is now weekly consolidation, has been for a month, coming into support 123 to 113. Monthly also is just going to move maybe a little bit sideways, right? These data center plays have ran very hot, and now maybe just some more monthly consolidation. I will be playing CoreWeave down here, but I'll be patient. This is where I bought most of my CoreWeave. I'm chilling, right? If they want to give me more buys, they're going to have to give me a little bit lower, and then we'll play it because we know the longer term thesis for expansion is quite clear, and the price per share in the future with bear and even base case scenarios can be quite attractive overall. The same thing can be said for a company like APLD, right? These are all just the fan favorite names that I'll be waiting for a bit more pullbacks. That being said, across the board in the rest of the market, some names have just been dying all across the board, whether it's Nike. Nike for me is a decent pickup down here, 60 to about 50 bucks. That's where we started to play it a bit more actively earlier on this year. They're midway through their turnaround story. They had decent earnings at the end of September, and the price right now is fairly good, right? But it is a longer duration turnaround story. That being said, Nike is probably my favorite bet. If we're looking at comparables, right, over on, look at on, man. Where have they been since May? Nothing but down. Where's Decker's Outdoor Brands been since May? Even though they posted pretty good earnings, down since May. I would tend to go with the stronger moat company, which would be Nike over time because of all their sponsorships and sports deals and things like that. But apparel has been very tough, right? Abercrombie and Fitch, where are they? That story is now done, right? American Eagle, right? They had a huge pop early in September. They haven't gone anywhere for years, guys. You know what I mean? Lululemon, very tough trade, stiff competition in this market overall. They're down tremendously, but not only those, right? The Chipotles of the world, which we covered on the Saturday video, and why I'm not buying any of these. This company, Kava, not interested right now. You know what I mean? Companies like Wendy's down ridiculously, not interested. There's a big consumer narrative right now, and it has to do with these companies losing members to cooking from home. So all the quick service restaurant companies, I'm not interested, right? At least right now, until we get data. I would rather be a bit late than be early and wrong. I'd rather wait for my timeframes to confirm new daily uptrends. Give me a tradable bottom and we can talk. If they're just going to hit us with the big narrative right now and just not bid consumer cyclicals at all, whether that's apparel, quick service restaurants, sit-down restaurants like Texas Roadhouse, perpetually down as well, right? Names like Cheesecake Factory, just perpetually down as well. It's the narrative. You know what I mean? These companies can report okay earnings, but it's the narrative. You're going to need to give me a switch if you want me to bid any of these names. Those are just a lot of the names that are hitting downsides right now that I figured it should be noteworthy to talk about, right? And also some of the value names. You can find really good value names like CP in this lower location right now. Tractor Supply Co., decent bid for as well. Or if you just want to play consumer staples overall and play them down here, not bad for XLP. Costco, not a bad bid. I mean, the stock is a bit rich, right? But just DCAing for a long-term portfolio here through this drawdown potentially, not that bad of a look. So you can find some pretty high quality value names that aren't just names like Procter & Gamble that just have like stagnating revenue and, you know, arguably very just low revenue growth rates. You know what I mean? Like they pay dividends fine, but like even if they do pay dividends, man, like I would like some top line revenue growth metrics as well, right? So amongst all the value names, I try to find the ones that have decent top line revenue growth, high customer retention rates, and decent moats. So those are not all of the companies, right? But a few of the bigger players, right? Some of the railroads, not too bad. Name like Costco, not too bad. I understand they're not the sexiest names, but those are some of the ones I'm looking into right now. If you take a look here to the upside, we talked about Iris Energy and their big deal with Microsoft, of course, today, right? Very, very, very strong. But you know, this one, when that news came out in the pre-market, right? Stock was up like 23, almost 30% of the highs. Look where they ended, 11%, right? People just stole off the news. So is this little niche of the market running out of gas because people can kind of see the writing on the wall with the market breadth? maybe, but let's just say it's less clear. The momentum is less clear than it was perhaps at this same time roughly a month ago, but very strong, and Iron shareholders should be very happy about that. But once again, that build out takes a lot of time, right? These deals are through 2028, 2029. Now in 2026, they're not going to scale that much. So we're pricing in a lot of forward revenue growth. Micron is absolutely insane, but once again, technicals are really hot. We covered them after earnings in September, right? At 155, they were decently valued. Even if the stock goes up to 300, it's still a 20 forward price to earnings. Very strong, but Micron is another example of a company where if we're holding with a long-term thesis because we bought down here or down here, that's fine. Starting positions up here, even though the valuation might be a little bit cheap, the technicals are very, very, very stretched, guys. It's not the best risk to reward opportunity for a technical and fundamental combo setup, which is my preferred setup in the market right now. Those are just a few of the few names, guys. I mean, we covered Eli Lilly. Eli Lilly was a fantastic trade. I don't know if a few of you guys took this one right here, but we were commenting this entire time. Beautiful weekly upturn recapture, moving average recapture, beautiful earnings as well, recapturing the months worth of a downward trend line. This is, guys, was like a year's worth of a downtrend, right? Breaking through it, back testing, and now expansion. That was a phenomenal trade, but it's coming into some of your take profit targets right now. Great trade, but right now, a little bit late. Phenomenal company for the long-term portfolios, though, that being said, right? And the rest of a whole bunch of these companies on this list right here, I can't really do too much in terms of coverage because a lot of them, they have earnings this week, right? Like some of the energy names like Vistra are strong, but a lot of these names have earnings this week. So we'll cover more price action as we move through this week in terms of earnings. A lot of the fan favorite names, AMD, Arista, like a lot of these guys have earnings. So I'll try my best to get you guys updated on, some trade opportunities and my thoughts on the biggest gainers and losers of the week. But as long as you guys understand, like conceptually how I'm looking at these things for positioning, both short-term for swing trades, but also long-term, building a long-term thesis and why it's okay to hold, but being not positioned with new capital, that is really what I want to bring you guys on this channel, right? The context is what I want to bring to you guys because I feel that in other financial YouTubers' information or videos, I mean, some of them are really good. I don't take anything away from some of my peers here on YouTube, right? But I find that a lot of the times, other people just lack context. And they don't explain the thought process behind why a trade is attractive to them. They just give some levels, they might give some statistics and stuff like that, but piecing together the puzzle, lining up the fundamentals, the technicals, that's what takes a little bit more context, a little bit further thought process. So that's what I want to bring you guys on the channel, which is why my videos are so darn long all the time, because I just explain these things in detail. So hopefully you guys appreciate my explanations. Now, last but not least, we can run through the portfolio a little bit, and I'll just do a quick little recap first of the trades that we made last week that we closed into this week. So the theme that you probably understood from the Saturday video and how I've been talking about the markets in the last week is the fact that I'm freeing up capital. Now, I'm never going to predict where the markets are going to go in the short term. We have conflicting statistics, right? Some short-term statistics like market breadth shows that we could get some pullbacks. Some longer-term statistics like historical performances of November and December when the SPY is up over 15 for the year show that it's a very high win rate. You should keep going higher in November. You should keep going higher December. You got conflicting statistics right now, conflicting narratives, and we did go over that in Saturday's video. So once again, I will refer you to that video for understanding the bearish current narratives at play and the contrast between the bullish tailwinds and why I am positioning the way that I am right now by just being a little bit more defensive in my positioning, not being super greedy on trades and just keeping buying power until either something breaks on the SPY and QQQ and we get the weekly and monthly pullbacks of 5-7% roughly, or until market breadth improves and the narratives also get a little bit more clear in my mind as well. But that's just me. But as we said in Saturday's video, everyone is different. If you don't want to do that, if you just want to go for it, go for it. But please watch Saturday's video to understand why, for myself and maybe for you as well, depending on which camp you're sitting in right now, could be interesting to kind of lighten up the positioning a little bit. That being said, our trades last week worked perfectly, right? A couple wheeled trades. I spent a lot of my capital trading earnings last week. Most of our earnings played out well. 2 standard deviations. Most of these plays, guys, were either lottery trades that we played on the week prior and just closed last week, but a lot of them were earnings trades with great distance. The only loss was Chipotle. I also closed out my Duolingo swing trades with shares because the narrative on that stock is somewhat unclear. I may revisit it in the future, but the narrative against the company is somewhat unclear, kind of like Google used to be, to where like the whole AI is killing their business. Now, I personally don't think that's the case. I think there's a difference between language learning services and language translation services, but the market doesn't care about that right now. And to be quite frank with you, at the $300 range, it's not as if the company is trading at the cheapest multiples either. I might just wait. I'm waiting until this company comes up with earnings, waiting to see, can they turn around the narrative? I might revisit it in the future, but this is a very small position, guys. It was a $1,000 position that I kind of took as a bit of a feeler position after we sold off heavily last earnings. I wanted to see if the market was able to turn around that narrative instantly and reverse some time frames. It didn't happen. So I will revisit that thesis later. We lost like $172 on $1,000, guys. It's not the worst thing. BYND was a tiny little 100-share lottery play for me. We lost a whole $43. Big deal. We got called away on a few things like Affirm and Sentinel-1. I got called away on Affirm because I didn't want to carry it into earnings this week. Unclear narrative unclear narrative with consumer right now, right? I think Affirm's going to report great earnings. I really do. And I think it's the best buy now, pay later company, bar none. That being said, it's pulled back a tremendous amount. I used to have call options that I had from there and closed them last earnings. I'm not re-entering. I'm going to wait to see their earnings, wait to see how the market responds to the earnings and the overall sentiment, because sentiment on fintech and payment providers recently and anything in relation to the consumer has been soft. So that's why I allowed myself to get called away on this Affirm assignment. But we made a good amount of money on that Affirm assignment since we were in, man. I mean, we were only in it for not too long at all. If I can actually find it up here. Here you go. We were assigned on October 17th. Got some good entry on the put credit premium, got some fantastic premium on the covered calls for a few weeks. And we made it out of that trade with 7.3% ROI, which was 2.43% per week. Sentinel-1, which we got called away on as well, we made 5.42% for a total of 3 weeks, which is like 1.8% per week. You guys know me on my selling options strategies. I'm looking for 0.5% per week. So we're able to wind down those two plays, free up a bit more buying power. And Amazon, which is another big winner for us, will be called away this week at $225. Our average cost on those shares, $210. So that as well will be coming out in terms of buying power this week. But overall, last week, it was a pretty decent week. No, nothing to really scream home about, right? Just another consistent week of ROI. As a result, you'll see here a big loss. That's not actually true. Today, we were down about $700. The reason it's down a lot more is because we just got a nightly reset on the after hours move. So you can see here, I have covered calls on Amazon. Those were down today because the stock was up. Stock was up about $950 as well, right? But now you see it took away that gain and it's adding the after hours loss on the Amazon shares, which is not true, right? So truly today, we were only down about $700, but Amazon, these shares, those covered calls will respond in tandem tomorrow, right? They will move. We got a lot of premium on these. Net, it's neutral right now. I probably, unless Amazon comes down to $225 this Friday, I will be called away on these Amazon shares. That being said, in terms of overall positions right now, I still have a lot of small swing trades that I'm keeping with good time on them, such as the Adobe bull call debit spreads, which are down right now 35%, CRM, as well as a short-term play down 6%, the JP Morgans, the Metas, which unfortunately was an earning. It was a move that I made into earnings that kind of unwound there, but that was a very small trade, $200. The JP Morgans are up right now. They're okay, but the banks are somewhat a little bit soft. They had a nice leg of expansion, but in the last few days, a little bit soft. Everything else here, guys, is leaps, right? AMD, these are leaps. December 2027. What do I care if the market swings a little bit? Amazon, December 2027. What do I care? My target is above 300 over the next few years. CoreWeave, December 2027. We're up nicely right now, but I don't care if the market is swinging these around a little bit. And Rubric, lastly but not least, right? These are also January 2027, going for some expansion. They're currently flat right now. Resolve, just a very small lottery play. We spent like, I don't know, like $300 on this play. Total profit is like north of 2,000. Good risk to reward, but you know, this one ran out of momentum a few weeks ago. And SPGI is another little swing trade that we took. We built this position on SPGI because I keep talking about it on the channel. We built it a few weeks ago when we were consolidating here, and now seems as though maybe it wants to move into our target. So we'll see, you know, short-term swing trades, some are up, some are down. The leaps are all doing well. We have more leaps all the way up here. XLV Healthcare, we closed one call option on those a few weeks ago. We're riding the last one, January 130 calls. Visa is a position I established, a call option. June 2027 320 call. We're currently like break even on the position right now. We were up as much as like 10, 15% at one point when we're up here, but we built it like back here, and Visa's just been doing a whole lot of nothing. But I do enjoy this area, and I have a whole bunch of time on my call options. I'm not too concerned, right? Sentinel-1, cheap cybersecurity play. I still have these leaps for January. We're up right now, but not the best. Bitcoin, this Bitcoin leap I'm down on right now, but not down tremendously. I've been saying that, you know, I will DCA this trade. I wanted to play this pullback into support, which we built back here a little bit. We're down a little bit on it right now. If we move a little bit lower down to here, like under 100K, I'll probably throw one more call option at this and call it a day. These are June 2027 out of the money calls. So of course they are going to move a bit more volatile. And today we put on a bit of a lottery position. This is just a fun trade, right? We put on grab calls, right? November 21st, $6.50 call options, $6 calls for February. You can see 3 of the Novembers for like 25 cents a pop. Who cares? And one $6 call for February, 80 bucks. Total cost of that trade was literally like 150 bucks. It's just play money for me right now. Nothing crazy, but you know, I just said 2 different call options right here. I say I never trade any long calls or puts into earnings. I never do, and you guys know that. Most of the time it's just short puts with good distance. That this is just for fun. We've been waiting for the grab breakout for 3 quarters now. Consensus looks good, guidance looks good, chart looks good, but the earnings is a casino, of course, right? Grab, I mean, very simple what you're looking for here, guys. Very simple, right? In terms of the chart, you're looking for the good old monthly breakout retest, yeah? Monthly breakout retest, looking for the run, setting up nicely into earnings, trying to build the short-term price action right there, trying to go for the weekly expansion right there. They had good earnings. They reported good earnings. The only problem is the stock didn't really move. It didn't really move at all after earnings. That initial pop, but they didn't really move. But they did have really good earnings. So maybe those calls end up worthless. The ones for November, we'll see. If I lose 70 bucks, who cares? We'll see. I'll probably keep the ones for February overall. But that's just a rundown of the portfolio. And we have a ton of buying power. I'm not using any margin, right? We have a little bit of cash right now. Amazon will be called away this Friday. That'll give me another $25,000 worth of cash, not using any margin. That's 30% cash for this account. Most of our plays in terms of call options are relatively new or ones that we have a lot of time on them and have built up a decent cushion of profits. You'll see here that my buying power right now is about 22,000. We don't have that many short puts running for the week. We have the BITX position, which is still assigned. BX, which is a short put play, 140 strike. CP, which is a bit of a value name right there, 70 strike on CP. 3 weeks, I got about 1.7%. Daily oversold conditions into 4 years of support. We talked about this trade a couple times on the top 5 options list. I'm just balancing some of my tech exposure with one value play right there. And the rest of the buying power is earnings plays. We played earnings plays on Palantir, on HIMS, and on Uber. 2 standard deviations, short puts, right? With a lot of distance on them. Palantir and HIMS are going to be wins. I'll free up the buying power there as well. So by tomorrow, I'll be back. I'll be playing some earnings here and there. I never recommend that you guys played as well. You got one SOFI option there that's pretty much worthless. So you can clearly tell, right? By the end of this week, like, or even moving through earnings, like I have an absolute ton of buying power right now, a ton of buying power. And like I told my Discord members today, guys, right? Same thing I said on Saturday. I posted this message. I said, you know, as I said in the live stream today and in both the weekend videos, I'm taking it very slow this week in terms of deploying buying power for wheel trades or any new swing trades. I don't like this market breadth at all. Today's another example of only big tech performing and everything else slowly dying. Until we either get an actual 5 to 7% QQQ or SPY pullback or better market breadth, I'll just be taking it slow. We were fully on the gas through the summer and early fall. I was using a lot of the buying power because we had clear narratives. Now the narratives are clashing and the short-term outlook is cloudy. Long-term earnings are good. Fundamental data is good so far. And in terms of earnings, good outperformance by earnings. And the AI megatrend is real. But short-term, the lack of breadth, technicals being overextended on indexes and AI and tech names, and concerns about consumers due to the lack of government data from the government shutdown had led us to a very concentrated market. Now it's just time to be a little bit defensive. There are times in the market to be fully aggressive. And when those times are here, we are fully aggressive. And you guys saw me go full on during the summer, right? There are other times where risk management needs to prevail, depending on your situation, and where we shouldn't be forcing trades just for the purpose of trading every day. This is one of those times, and I reiterate to my members and also to you guys, don't just trade for the purpose of trading, guys, right? If it's just not clear, then just don't trade. Take a bit of a pause, take a bit of a pullback. You guys should all be up good money this year overall. Now it's kind of time to keep that money when we have a bit of a clash of narratives right now, clashing of statistics, and the market environment is a bit cloudy. So that's kind of all the things that I wanted to say for the portfolio rundown and my positioning. I will be taking it very slow this week, and only if some of my highest conviction names come into my actual levels will I be deploying the buying power. If not, we're just going to sit. We're going to let what we have kind of just marinate and do its little thing. But I'm saving for any new leaps or any short-term swing trades. I'm saving the money for wheeled trades. They have to be A+++ setups. Some of the names in the top 5 options, right? And that's only when I'll be using the buying power. And last but not least, just for some context, guys, you might remember I started this account early this year with like about $47,000. We did good early starting off the year. And then I took a massive bet into tariffs, which is one of the times that I chose to call out the market bluff. Now, you might remember, guys, 2023, we had a very good year. We were up like 75% to end the year. First year on the channel. 2024, the account put up 65%. This year, I chose to start the account with half the amount for the YouTube portfolio. Usually 2023, 2024, I started it with $100,000. This year, to make it more manageable and more relatable, I promised you guys I would start off with half of that. We started off with like 46, 47,000. But when you have a smaller account like that, right? Sometimes you got to take more risk, calculated risk for a thesis. If it plays out, it plays out. If it doesn't, it doesn't. You can see we held up okay during the tariff sell-off. And then I built positions more and more, wanting to call off the tariff bluff. I thought my thesis at the time was when Trump would disclose the reciprocal tariff rates, we would get 10 to 15% across the board, which was the market consensus. And as a result, all of the sentiment-driven sell-off would kind of just be bought up. Sadly, we were mistaken. We got 40, 50, 60, 100% tariff rates across the board. Markets unwound, and I had to change my positioning. And as a result, the account from being up 16 throughout the year earlier, down and down and down to down 36%, guys, right? It's been a heck of a road to recovery. We repositioned into some favorable plays, especially after the Trump tariff pause. You remember, like a week after he destroyed the markets, he paused the very same tariffs that he put out. As a result, we readjusted our positioning, found the best plays in the market, continued running the wheel, and slowly but surely, no crazy home run trades here, just consistent trading over time, not getting discouraged, just sticking to the plan, right? All of these, I'm telling you guys all the time, I never go for home run trades, right? My portfolio is always positioned the same, arguably, right? Since that tariff sell-off, just consistent trading, wheel, and carefully chosen leap contracts overall. And that is what allowed us to slowly catch up to the benchmarks, start outperforming. Now we currently stand at about 30% year to date, which is about 2 times the index performance right now. Obviously, there's about 2 months left. We will see how it goes, but we've done a pretty good job here of coming back, right? After being, guys, I was like 3 times max margin on that thesis. I was saying, you know what? It's time to go for it, right? If I want to call out the sentiment bluff of the markets at that time, and go for it with a smaller account size and go for maximum growth, I'm going to go for it. Whatever happens, happens. If I have to reposition, manage the risk, close some positions, reallocate, that's exactly what we'll have to do. But I tell you guys about that stuff while I'm doing it. Right now, we've slowly caught up. It took a while, not discouraged at all throughout the process. Trust the process. Just keep trading. Base hits over home runs, right? Never try to chase ROI or say, oh, I'm underperforming, right? No. Just keep following the plan week in, week out. And we got at a margin, right? We've deployed margin carefully over the past 4 or 5 months of this rally recovery. Not as much as we had back here, but carefully utilizing margin throughout this process. And now we're kind of back up here. So could the year have been better if I didn't take massive risk coming into tariffs with that thesis? Of course, guys, of course, right? But it is what it is. Sometimes you have a thesis, sometimes it works, sometimes it doesn't. The best thing you can do after, if something happens, right, is just derive the new thesis, analyze things for what they are. Don't predict too much, don't speculate too much. Just keep going for the same trading styles that you guys are used to. And eventually, if you have a consistent strategy that otherwise outperforms the benchmarks in normal markets where we're not dropping 5-6% per day with a big bearish narrative, then you should be doing okay, right? So that being said, this is our performance for the year. Obviously, in hindsight, it's very easy to say, well, I should have just leveraged the account here only in call options and gone for the moon, but you never know, right? Every week is a new week, and you have to manage the risk every single week and have to just trade consistently base hits over home runs. At least that's my style. So far, not too bad. Year could have been better, but we are outperforming the indexes, which is our purpose. Once again, 2023, 75%, 2024, 65%. This year, 30%. We'll see where we end up by the end of the year. But we've had some great years on the channel, great years in the long-term portfolio, and that is just the overall performance. So I figured I should give you guys an update because it's been quite a while. And that is everything I had for today's video, guys. Hopefully you enjoyed. If you did, consider dropping a like. Would really appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. And last but not least, guys, if you have any questions, feel free to leave them down below. That's it for me. Another big video, but this is going to be the end of the warnings, the context for trades. We'll make the videos shorter now because I've been reiterating the same point. Consider yourselves warned, or whatever you want to call it. That's it. See you tomorrow. Peace.